Hi, yesterday I was doing some continuing education and it reminded me of something I've been saying for a long time. And that's really that the central banks are really daring you not to take on risk. And I think ultimately what it's doing is it's driving or mandating investor irrationality. So this is a nice little cartoon. It's meant to be funny, written by the guys at Hedgeye. And but really, this is exactly what the central bankers want. They want you to be irrational. And let me explain what I mean by that. So here's just like super quick time value of money. Now tell me where I'm wrong. Tell me what's wrong about this admittedly simplistic analysis. But first off, time value of money. The idea is if you have X amount of dollars, like $10,000 today is worth more than $10,000 in the future. So $10,000 today is worth more than $10,000, say, a year from now, 5 years from now, 10 years from now. Now, why is that the case? The way that is the case is because with inflation, $10,000 today has more spending power than it does in the future, right? If inflation is positive, then money's worth more today in terms of its actual spending power than it is in the future because inflation deteriorates the spending power of that money. All right. So if you are a saver, the only rational reason you would forego your present consumption is if you earned enough interest on that money to make your future consumption greater than it is today. Right? That's the only way it's possible. So interest on a savings investment has to be greater than the expected inflation or what the realized inflation in order for that to be a worthwhile trade-off. Okay? What tell me where I'm wrong. That's the only way it rationally makes sense for you to save. Now, what the Fed's doing, and I should say Fed, the central banks in general, with their one-stop playbook, and by that I mean they're all the same, everyone has the same playbook. What they're doing is they're saying, hey, savers, we're going to lower interest rates so much that you have a couple of choices here. You can save like you normally would, but if you do that, you're going to be worse off. The spending power of your money today is greater than it will be in the future. You are going to lose real dollar value if you choose to save, even if that makes sense from a rational perspective in terms of risk. Okay. Or you can switch to an inappropriately risky asset. Okay. From a risk standpoint, it doesn't make sense. But now it's risky. So you don't know what the end game is, right? So you're saying either. So in either case, it's irrational. You can irrationally lose money or you can irrationally take on more risk than you want to take. Now, what that does is by people switching from savers to investors, it creates a demand shock, right? There's more demand for risky assets. Therefore, the prices of risky assets go up. All things equal, if they were intrinsic value, now they go to be more expensive than intrinsic value. Okay. So now as an investor who actually wants to invest, you can invest and be worse off because now you're buying inflated assets, right? Or you can then take more risk, okay, more risk than is appropriate given your circumstances. Every choice you have here is irrational. There's no rational way to save or invest given the fact that the central banks have manipulated the markets. Okay. So what I want you to do here, I want you to challenge conventional thinking. Okay. And I also want you to recognize that the central banks have distorted the normal market mechanisms. They are no longer functioning. All right. Tell me where this admittedly simplistic analysis of what the central banks are doing is wrong. Now, I want to say one caveat given the pandemic crisis, they largely didn't have a choice. But I want you to think about this in the context of the last 20 years. How often have interest rates that a saver can get, how often have they been higher than the inflation rate? It has been few and far between. It's rarely happened. Think about that. Thanks so much for listening. Take care.